Before we dive in, a quick note, I'm Dr. Lei's digital twin. I deliver the doctor's proprietary scripts, translating dense CFA logic into high-impact guides designed for one purpose, to stop you from losing points. To see if your knowledge holds up under pressure, head to the Study Buddy website. We provide the only tools designed to audit your true understanding and provide a surgical critique of your essay effectiveness before the CFA graders see it. This content is for educational purposes and is not affiliated with, sponsored by, or endorsed by the CFA Institute. The CFA Institute loves to trap you on exogenous shocks because they know you're tempted to just project the past into the future. But the number one reason candidates fail these macro questions isn't failing to memorize GDP, it's failing to see how a sudden shift in the regime breaks every model you've built. Here is the logic you need to beat them. Imagine you are a chef who has perfected a recipe for sourdough bread over 10 years. You know exactly how long it rises and the exact temperature. Then, one day, the humidity in your city permanently jumps by 40%, and your oven's fuel source changes from gas to electric. If you keep using your old historical average timer, your bread is going to be a disaster. In the world of the CFA Level 3, those humidity and fuel changes are exogenous shocks. Today, we are talking about economic and market analysis, exogenous shocks to growth. This is the art of figuring out when the old rules of the economy are being tossed out the window and how that changes what you should pay for a stock or a bond. The link between the economy and your portfolio. Let's start with a reality check. The curriculum points out a fundamental mistake many analysts make, losing sight of the fact that investment outcomes are tied to the economy. If you ignore the macro, you fall into traps like the 1990s tech bubble or the 2008 financial crisis. Think of the economy as a massive cruise ship. Trend growth is the steady long-term speed of that ship. It's the average path of gross domestic product or GDP. While the ship has a steady speed, it also deals with business cycles, which are the waves that make the ship speed up or slow down in the short term. As an analyst, you have a competitive advantage if you can spot when that ship is about to change its cruising speed. Most people think trends are easy to forecast because they move slowly. But that's only true if the trend stays constant. The danger is when an exogenous shock happens. These are outside events that are almost impossible to see coming. They aren't priced in yet, meaning the market hasn't adjusted the cost of assets to reflect this new reality. The 6 Horsemen of Growth. Shocks. The curriculum lists 6 specific sources of these shocks. You need to be able to identify these and explain if they help or hurt growth. Policy changes. This is about government rules. Pro-growth policies include sound fiscal policy and minimal intrusion. If a government suddenly slaps on trade barriers or tariffs, that is a negative shock that slows down trend growth. New products and technologies. Think of the steam engine, the internet, or AI. These enhance potential growth because they let us do more with less. Geopolitics. Usually conflict is bad because it diverts money toward weapons. However, a peace dividend, like when the Berlin Wall fell, is a huge boost because governments can reinvest defense spending into the economy. Natural disasters. These destroy productive capacity, the factories and roads we use to make things. While they hurt in the short run, they can actually help long-run growth if old infrastructure is replaced with brand new high-efficiency facilities. Natural resources. Finding new oil or a new way to extract it, like fracking, is a boost. Conversely, if a group like OPEC cuts the oil supply, growth takes a hit. Financial crisis. This is the big one. A crisis happens when people lose confidence and stop lending. This doesn't just hurt for a year, it can actually break the trend growth rate forever. Mock candidate review. Manager Q&A Question 1. The Type 3 Crisis Trap. When a manager says, our team is looking at a region that just suffered a massive banking collapse. Since the crisis, the total GDP level has dropped 10% and has never recovered to its old path. Furthermore, the speed at which the economy is growing now is only half of what it was before the crash. How would you classify this? The analyst should see that this is a Type 3 financial crisis. It is the most severe because it involves both a persistent decline in the level of output and a reduction in the subsequent trend rate of growth. If we look at the Eurozone, this was driven by rigid labor markets, an aging population, and a lack of unified fiscal policy. Question 2. The growth-enhancing paradox. When a manager says a major hurricane just wiped out a coastal manufacturing hub, why might you argue this could be growth-enhancing in the long run? The analyst should answer. The key word is efficiency. Long-run growth may increase if the destroyed capacity is replaced with more efficient, modern facilities. It's a reset that allows the economy to upgrade its technology faster than it would have through normal wear and tear. Question 3. The equity return anchor. When a manager asks, a client assumes that because GDP is growing at 8%, the stock market will return at least 8% plus dividends. Why might they be disappointed? The analyst should answer like, we estimate the total value of equity by multiplying 3 factors: nominal GDP, the share of profits in the economy, and the P/E ratio. The client may be disappointed because high growth might already be priced into a high P/E ratio, or the rate of return on capital could be driven down by massive overinvestment. Question 4. Calculating the baseline. When a manager requests, give me a baseline projection for U.S. equity returns. Labor input growth is 0.9%. Productivity growth is 1.5%. Expected inflation is 2.1%, and the dividend yield is 2.25%. An excellent answer from the analyst is, the baseline projection is 6.75%. We get this by adding all 4 components together. As for the historical P/E growth of 0.9%, we should exclude it. In the long run, the P/E ratio cannot increase forever, and we should expect a reversion to the mean. You take the dry data, find the anchor, and explain the direction of the trend. If you can do that under pressure, you're well on your way to that charter. Keep your head in the game. Excellent job today. Until next time, bye for now.